back to markets right now, though, and a look across the major indexes. The Dow staging a little bit of a late day comeback here. It's now up 50 points, just shy of the 16,500 mark. Take a look at the NASDAQ. As we mentioned, it is the laggard today, and in fact, so far this year, it's down again by only a couple of points, so we'll see if things turn around there. And finally, the S&P 500, some small gains, but it doesn't do much to get rid of the sell-off we saw yesterday, Bill. And again, a lot of people talking about the weakness in these indexes for today, for yesterday, and whether that or how that bodes for the rest of the year.
Yeah, I know it's only the second day of the year, but it's one we keep an eye on here. Joining us, let's talk about today's markets in our Closing Bell exchange with Aaron Gibbs from S&P Capital IQ, Bill Stone from PNC Asset Management, David Kudla from Mainstay Capital Management, Ken Mahoney from Mahoney Asset Management, and Rick Santelli from Rick Santelli
Asset Management.
Yeah, or something like that. Aaron Gibbs, Kelly and I were talking yesterday about it. We forget how different the mood was last year at this time going into 2013. I mean, last year, there was a lot of fear going into the year. This year, a lot less fear. You agree?
Yeah, to say the least. I mean, this year is really the mirror image of 2013. Last year, we had nothing but a lot of roadblocks that we had to get over between, the sequestration, tax hikes, and so on. This year, it looks like we're starting to fire on all cylinders, and the expectations are significantly higher.
What makes you so confident that the indexes will keep rising from here?
So the main thing is earnings expectations. That's number one. Right now, we're looking at earnings growth of about 10% for the S&P 500. So with those kind of expectations going into the year, we still expect us to be in positive territory by the end of the year. On top of that, of course, we've got the GDP growth finally inching up about 3%, still low inflation, housing recovery, and so on. So we see everything looking towards a positive year.
Ken Mahoney, you agree?
Yeah, look, I think we're going to have a positive year. Most people expect, like the S&P earnings growth to be between 8 and 10%. But you know what? There's definitely some giddiness that is some room for concern. And it kind of reminds me sometimes of the late 90s, where you had the most conservative investors. They'd call our office and they'd say, buy me shares of that Yoo-hoo. What do you mean, that chocolate beverage drink? Yahoo. And we're starting, fast forward 13, 14 years, we're getting some of those calls in the office again. And, my nephew told me to go out and buy the company that tweets or Twitter. What's going on there?
No kidding. That's like our shoe shine anecdote here.
Yeah, so, look, overall, I think the market's going to go higher. But, when there's fear, that's, Warren Buffett talks about it so eloquently. So at the end of the day, I think the market's going to go higher. But I think, investors are going to be tested this year. I think there's going to be more volatility. I think there's going to be some corrections. I think there can be a good shakeout to really test the fortitude of investors this year.
It just occurred to me, speaking of Warren Buffett, when you compare today, right now, this period to the mid to the late 90s, Warren Buffett's buying stocks now. He wasn't buying stocks in the 90s. He didn't understand.
Right, he still likes the valuation.
Fully valued, yeah.
Yeah, he still likes valuation, too.
David Kudla, what are you looking at right now as we go into 14? Are you nervous? Are you ebullient? What are you feeling right now?
Well, I'm not nervous about the stock market, maybe not as nervous as some others are. We think we'll have reasonable earnings growth this year, with revenue growing 4 or 5% after being flat this year. That bodes well for earnings and the opportunity for multiple expansion. And the economy is improving. We expect a significant improvement in the economy next year. So that takes us to industrials and other cyclicals. The CapEx, we expect that globally, companies will be spending, will have capital expenditures. So the CapEx cycle that we've been waiting for will help technology.
And keep waiting.
And keep waiting. But we think that finally comes in 2014, and that'll help the tech stocks and some of the other capital expenditure, those beneficiaries of a CapEx cycle.
All the same, so here, today's an interesting microcosm, though, or a test perhaps of that thesis, because the financials are doing quite well, one of the only sectors doing well today, and yet technology, again, if you look across the NASDAQ the last couple of sessions, is really under pressure. What's going on, David?
Well, we've got this, the sell-off yesterday, come back a little bit today. It's probably just some tax loss selling at the beginning of the year. We're not going to make too much of one day. As far as the financials, though, that's one of our favorite sectors in 2013. It continues to be in 2014 with net interest margin increasing. So we like the banks, we like industrials, we like technology. All those global cyclical plays we think are going to do very well in 2014. Okay. We get through a couple days of digestion here, and we're going to see an improving market.
Gentlemen, hang on one second there. And Bill Stone, we haven't forgotten about you or you, Rick. We got some breaking news for just a second. Phil LeBeau stepping in with some of the latest automotive sales news today. Phil?
Bill, all the numbers have been tallied. Auto Data, a research firm that tracks the auto industry, says that the December sales pace was 15.4 million. That's below what many on the street were expecting. They were expecting something closer to 15.9, maybe even 16 million. But the real important news here is that the total number of sales for all of 2013, 15.6 million. That is the strongest annual auto sales in the U.S. since 2007. Guys, back to you.
Still, all the same, that does take the bloom off the rose to see that big of a drop in December. And I understand people are citing the weather on this one, but, that raises hackles for everyone who's heard that kind of excuse in the past.
Right. Right, but I think the ultimate thing that you want to look at here is the trend when you take 3 months at a time. And if you look at the 3-month trend for auto sales, it continues to move higher. So let's see. If we see this continue in January and February, then perhaps it's time for people to be a little bit worried about the consumer.
Phil, thanks very much. We'll see you later. Bill Stone, that's the kind of news that the markets essentially would have ignored for the most part in 2013 because they were still on the morphine drip at the time. You feel like we're going to be focusing more on fundamentals, though, in 2014, right?
I think we are, but I think he's right to say you do have to still keep in mind the trend. I think what some other people talked about is I do think it will be more challenging this year because you do have higher expectations built in just because of the valuation of the market. But we alone feel like the consumer is in really good shape, honestly, in terms of net worth gains. We'll see at the end of next week again what the non-farm payrolls look like. But I do think it is going to become more of a, pay attention to maybe more individual company dynamics rather than as much as the macro environment, perhaps like we saw last year.
Well, speaking of that macro environment, Rick Santelli watching the 10-year here flitting back and forth above and below the 3% level. Is that significant?
I don't think it is personally, Kelly. I think the Treasury market at this point is pretty much shadow boxing what's going on in the equities. The equities deteriorate, rates move lower, the equities improve, we see rates move higher. Home base continues to be right around 3%. Next week, Tuesday, Wednesday, Thursday, we get the first set of Treasury auctions, 3s, 10s, and 30s, 64 billion. That'll be interesting. We get the first real top-tier data Wednesday and Friday on employment. And, I just can't see how 2014 is going to be as good for the equity markets as 2013. There is no doubt that the economy is improving. I think one of our guests said firing on all cylinders. I agree, except for it's a small, mid-size economy sedan versus a Lincoln Town Car. And I think that's the problem. And I think that this inventory impact on GDP, that's going to dissipate quickly. I think by the first or second quarter of 2014, we're going to come to realize that these solid 3% real GDP numbers probably are a little bit optimistic.
Before we let you finish up here, what kind of response or demand do you think there will be for the Treasury auctions next week, bearing in mind they're the first ones that are being conducted on that scale after the Fed announced a tapering, that will begin this month? What do you think?
I think the 3-year will go pretty well. I think it's the longer maturities that I would be a little concerned about, so I want to see what the demand is. I know the old argument, as rates move higher, you bring in a new crowd of investors, but I think the duration risk early on until we see, as we get into a real taper, maybe closer to quarter year or mid-year, I think it's going to take a little bit out of those long-term demand of the auctions.
Yeah, Aaron, you get a number like the auto sales hit 15.4 million. That's a pretty big step back. Do you read further into that to try and, change to any tactical positioning as a result?
No. Again, I do poo-poo that a little bit just because of the weather in December. And again, just looking more at the trend. So auto sales are not one of our bigger concerns.
And what about that sector generally? Because it's been one of the strongest, one of the bright spots really for the U.S. economy here. People have been able to get loans. Financing is there. Ally Financial may be coming to market in the early part of next year.
Look, across the board, all of the consumer discretionary, it's hard to find decent values. We're really starting to look at some of the other sectors for where we're going within 2014. All the high flyers from 2013, the internet retails, the autos, and so on, it's challenging to really look at these valuations and say, do I think this is going to be another winner in 2014?
Thank you. We're going to move on here. We got some news getting ready to break. So thank you. Happy New Year. Appreciate your thoughts.
Thanks.